The Finance Minister Nirmala Sitharaman replies to a question on the sliding value of the rupee.
Rupee has lost less than 1% of its value against the US dollar.
Indian rupee has plummeted to an unprecedented low.
Rupee has breached a key psychological threshold.
As the rupee free fall continues for 16 straight months.
Imagine you're standing at a petrol pump watching numbers climb faster than you expected. Or you're in a medical store quietly calculating whether to buy the full strip of tablets or just half for now. Or maybe you're scrolling on your phone and notice
my OTT subscription fee just shot up 20% in 1 month.
all of this points to one thing. Somewhere in the background, something invisible has shifted. The invisible thing is the Indian rupee.
रुपए की कीमत घट रही है.
It's a historic low for the Indian rupee. That's very sad.
जब डॉलर मनमोहन सिंह जी के टाइम में जब हाई चल रहा था तो इन लोगों ने क्या कहा था, तो आज क्या जवाब दे रहे हैं इनसे पूछिए ना.
प्रधानमंत्री जी को बधाई 90 तक पहुंचाने के लिए 100 तक पहुंचा देंगे जिस गति से रुपया जा रहा है.
The fall of the rupee is not a breaking news event for most people. It doesn't arrive with sirens. It creeps in slowly, quietly, and by the time you notice it, it has already eaten into your monthly budget. What makes this harder to grasp is that the rupee has been falling for so long that many of us have grown up assuming that this is normal. In 1947, $1 was worth around 3 rupees. In the early 90s, it crossed 17. Today, it's hovering around 91.
Well, it is a deliberate choice, I think. The RBI is allowing the rupee to depreciate. This is not a very drastic depreciation. Of course, when you look at things like 90 rupees to the dollar being a level that is close to being breached, etc., it seems rather dramatic. But the reality is that the rupee has depreciated less than 10% against the dollar this year.
This is not a one-year story. It's a generational one. And to understand why this keeps happening, we have to start very far from India, thousands of kilometers away, in the United States. With a currency that controls the world more than any army ever could. The US dollar is not just America's money, it's the world's money. Oil is bought and sold in dollars. International loans are taken in dollars. Big companies keep their profits in dollars. And even countries that don't trust each other still trade in dollars. And when someone tries not to, they get a threat.
So they wanted to try and take over the dollar, the dominance of the dollar and the standard of the dollar. And I said, anybody that's in the BRICS consortium of nations, we're going to tariff you 10%.
Over decades, especially after World War II, the dollar slowly became the default language of global business. So when something changes in the American financial system, the effect is felt everywhere. And one of the most powerful levers in this system is the US Central Bank, the Federal Reserve.
This is the Federal Reserve headquarters in Washington.
Good afternoon.
When the US Central Bank, called the Federal Reserve, raises interest rates, it is basically telling the world, keep your money with us, we will reward you more.
The U.S. Federal Reserve has decided to increase interest rates. I think it's time to move my money.
Higher interest means safer and better returns for global investors. Pension funds, insurance companies, and large investment firms move their money to the US because it suddenly feels like the safest parking spot. Money flows out of riskier places, countries like India, and flows into America. This movement doesn't happen on television. It happens on computer screens, inside trading rooms. But the impact shows up in your daily life. When investors pull money out of India, they sell Indian assets and convert their rupees into dollars. That creates more demand for dollars and more supply of rupees. Just like any other market, when supply goes up and demand goes down, prices fall. The price of the rupee falls. And when the rupee falls, everything India buys from the world becomes more expensive. This is where the story usually stops in most explanation. It's because of the dollar, they say. But that is only half the truth. Because many countries face a strong dollar. Yet, not all countries have their currencies fall in the same way. Some weaken slowly over decades, some crash suddenly. India's story sits somewhere in between.
I think Indian rupee has performed much better than many other emerging market currencies. But I think the efforts are by the RBI more towards there are not too much of volatility. It is not to intervene in the market to fix the value of rupee.
The rupee has not collapsed overnight, but it has steadily lost purchasing power over generations. So now the story turns inward, towards India itself. India imports a lot: oil, gas, electronics, machinery, medical equipment, fertilizers. Even parts used to make products inside India are often imported. Most of these things are paid for in dollars. So when the rupee weakens, India needs to spend more rupees to buy the same things. Even if global oil prices remain stable, petrol and diesel can still become costlier inside India because the rupee is weaker than it was a decade ago.
Rupees weaker, same phone costs more.
The cost doesn't stay limited to fuel. Transport becomes expensive, vegetables cost more to move from one farm to the other, from farms to cities. Bus fares, cab fares, delivery charges, everything feels slightly heavier on the pocket. This is how currency weakness turns into inflation. Not overnight, but steadily. Year after year, quietly reducing what one salary can buy compared to the previous generation. Now add another layer. India also depends on foreign investments to fund its growth.
To my entrepreneur friends from across the globe, I would like to say, come, make in India.
Roads, factories, startups, stock markets, a large part of this money comes from outside.
India's GDP growth hit 7%. I think I should invest in India.
When foreign investors feel nervous because of global tensions, rising US rates, or uncertainty about trade, they pull back. In recent years, especially around 2024 and 2025, foreign investors sold large amounts of Indian stocks and bonds, and that selling pressure weakened the rupee further. Here is where it becomes a loop. Investors leave, rupee weakens. Rupee weakens, investors worry more. They leave even faster. And this is not about India doing something terribly wrong overnight. It's about confidence. And confidence moves faster than facts. Now, to keep that confidence from collapsing entirely, someone has to step in. And the role falls to the Reserve Bank of India.
Our effort has been always to reduce any abnormal or excessive volatility. And that is what we will continue to endeavor.
It's not helpless. It has a very large reserve of foreign currency built slowly over decades, especially after the 1991 crisis taught India a very, very painful lesson about running out of dollars. When the rupee falls too fast, the RBI sells dollars from its reserves and buys rupees. This supports the rupee temporarily. Think of it like using savings to manage a tough month. It helps, but it cannot become a habit. Because reserves are not infinite, and using too much too quickly creates another fear. What if the RBI runs out of dollars again? Even the memory of past crises makes markets nervous. So the RBI walks a tightrope. It slows the fall, but it doesn't try to stop the river entirely.
Saw this earlier in February. The rupee to dollar had climbed up to almost 88, and within a period of 3 months it came back to below 84. So these fluctuations, this volatility does happen, can happen.
At the same time, the RBI faces another problem: inflation. If prices rise too fast, people suffer. So, the RBI may raise interest rates to control inflation, but higher interest rates make loans expensive. Home loans, car loans, business loans. Everything slows down. Growth slows, jobs slow. So, the RBI has to choose extremely carefully: protect the rupee or protect growth. Often, it has to do both imperfectly. Yet, not everyone loses. Exporters earn more rupees for the same dollars. IT companies, pharma exporters, and tourism businesses benefit.
It basically means that imports will become a little more expensive. Exports will be cheaper in the sense that for foreigners, we'll be able to produce our products cheaper than they would be than our competitors would be producing them, and therefore our exports will receive a little bit of a boost, even in the US market where they are facing very high tariffs.
This is why a weak rupee is sometimes called good for exports. But this benefit is uneven. It does not cancel out the pain of higher fuel prices, medicine costs, and the imported inflation for majority of households. There's also a quieter issue. India's foreign money is often short-term. Stock market investments can leave in a day. Long-term investments like factories and infrastructure don't leave so easily. When too much growth depends on short-term foreign money, the currency becomes sensitive. Every global shock hits harder than it should. Add to this the trade tensions and policy uncertainty. When global trade relationships become unclear, foreign buyers hesitate. Orders slow down, investors dislike uncertainty more than bad news. Even headlines can shake markets. In recent times, for instance, trade friction and geopolitical fears pushed more money towards the dollar away from emerging markets like India. Now circle back to where we started, the dollar. Even if India fixes many internal issues, the dollar will still matter. As long as oil, trade, and global debt are priced in dollars, countries like India remain vulnerable to its rise and fall. Reducing this dependence takes decades. It means building stronger exports, deeper domestic capital markets, and an economy where growth is funded more by local savings than foreign fear. So why is the rupee falling? Not because India is falling, not because of one bad policy, but because global money is expensive right now, because investors are cautious, because India still imports more than it exports in critical areas, because confidence moves faster than fundamentals, and because the global financial system was designed in a way where the dollar sits at the center, pulling everything toward it whenever fear rises. The real danger is not a falling rupee by itself. The danger is a slow erosion of purchasing power across generations, a quiet squeeze on households, a hesitation in business decisions, a future where next generation has to earn much more just to live the same life their parents did. Currencies are stories written every day by millions of decisions. Some made in Washington boardrooms, some by traders, some by policymakers, and finally by ordinary people like you and me adjusting their lives.